want to wait for another.
Very good evening to all. So warm welcome and very good evening to all behalf of CLAFMA in association with the NCDEX on the webinar Hedging Price Volatility of Feed Ingredients Using Commodity Derivatives. I think last almost 3 to 4 months, our industry has seen the volatility and the spike, I can say unusual spike, uncertain spikes in the raw material, particularly in the soybean. And it's huge. It was huge, and it is. We are struggling how to manage our feed cost, because almost 80% has risen, particularly in the soybean meal price, and there are huge increasing spike in the soybean seed also. So during interacting with last 2 months, there were several questions came across when we discuss with the industry people, you all people who are now in the participants, that everybody has questioning that why it is happening. So what are the why is there any speculation of future trading is because of hedging of big groups, or it is globally the edible oil issue, import issue, some data authenticity, question mark on the authenticity of the data, and all these questions. Then we internally as a representing CLAFMA, my name is Dr. Sujit Kulkarni. I'm managing committee member, also representing Trau Nutrition. So we discussed internally, and we thought that to support industry, and we should arrange one webinar, and we call the experts who are really work on this commodity market, and that was the reason. So just before giving handover to the chairman of the CLAFMA, I would like to have a few requests to all participants that to maintain the quorum and to maintain the flow. Most of all participants are on the mute form, but whenever you want any questions for particularly any speaker, please feel free to write down in the question box. So we'll try to take maximum questions, and we'll try to ask our expert panelist. So with me, along with the panelists, I'll introduce one by one when they come their turn. And now first I will introduce or invite Mr. Neeraj Srivastava. Neeraj Srivastava is in the industry, livestock industry for South Asia more than 28 years. He's presently chairman of the CLAFMA, and also he represents Novus as a MD for the South Asia and Central Asia. I'll request Mr. Neeraj ji for the welcome to all participants, and also highlight some key objective of today's webinar. Yeah, Mr. Neeraj, please.
Thanks, Dr. Sujit. I think you have given a very nice brief of today's webinar. So good evening, everyone. On behalf of CLAFMA and its managing committee members, I would like to welcome you all in today's webinar. It is our endeavor to bring something new to help our members related with relevant and burning industry issues. As Sujit explained, price volatility of feed grains are one of big challenge and concern to our industry today. Commodity price risk is a financial risk, and that is market driven based on the supply demand fundamentals of the commodity. The global commodity markets are witnessing high volatility, which directly or indirectly impacts the bottom line of a business. This risk can be efficiently managed during derivatives tools, or more commonly what we say price risk management tools like future and options. Hedging plays a crucial role in the industry today to protect margins and shareholders' value by incorporating proper risk management mechanism. We will try to understand hedging and its importance today through our panel members. I think Bhupalini from NCDEX, she was behind us, and she was kind enough to arrange this webinar with the elite panelists today. Once again, I welcome all participants in today's forum and looking for a very interactive session. Thanks everyone for joining this session today.
Thank you, Neeraj ji, for your warm welcome and explaining the key objective. So our first speaker and first panelist who is going to talk is Mr. Kapil Dev, and I have privilege to introduce him. Mr. Kapil is presently designated as a Chief Business Officer at NCDEX. Mr. Kapil, more than 14 years experience in agri-commodity market. Before joining NCDEX, Kapil was associated with Shriram Fertilizers and Monsanto India Limited. He is basically agriculture graduate with MBA, and with so much of experience, and almost last 9 years with the NCDEX, I think he's the right person to talk on future and hedging markets and introduction of NCDEX. So Kapil, floor is yours.
Thank you. Am I audible?
Yeah, Kapil.
Okay. Thank you. And thanks, everyone. I welcome you all on behalf of NCDEX to this very much awaited discussion we wanted to have with CLUFMA and its members on hedging and price risk management. Leading agriculture exchange, agri-derivative exchange of the country do offers futures trading almost 20 plus commodities, and feed ingredients plays an important role in our offering, whether it's soybean and its derivative. Then we have grains, barley, bajra, wheat, maize available with us, and then we have few others close feed ingredients like cotton seed oil cake also. NCDEX is a stock exchange regulated by SEBI, which is the regulator of Indian financial market. And all the contracts and the rules and regulations are defined by SEBI, and that's how we do operate. And along with SEBI, we also follow FSSAI, EGMARC rules, and all the warehouses we own are associated with us are WDRA approved warehouses. So this is a close knitted and highly regulated ecosystem. And this market, of course, no doubt that offers a platform for hedging and price risk management. And that's the economic rationale to having of the derivatives market in the country and elsewhere. And with on the same path, we are also moving slowly and gradually. So we are 18 years old now, almost, when we started our operations. And the journey has been remarkably well. A lot of developments has happened over a period of time. And I think now, at least, we have established the concept of hedging among the Indian value chain participants. And I think slowly and gradually we are moving towards a risk-free agri sector the way we have been progressing in the last 5-10 years. So I would definitely set context for rest of the panelists who are much more equipped to speak on that what exactly hedging is, what are the fundamentals which drives prices of commodities, how the corporates, we have Rajiv here from ITC, are using these derivatives market for their risk management against the commodities they are dealing into. We have Sumit, my good friend, who will definitely cover the fundamentals. And of course, we have Rajni, who is closely associated with various corporates into agri sector and helping them to hedge and see, closely observe that how these corporates use a derivatives market and what benefits they are drawing out of it. So I have a small presentation, not a technical one, but just to set the context that why hedging is required and what drive actually people to hedge. Is it visible, Mr. Sujit?
Yeah, not yet, Kapil. It's showing appearing starting.
Okay. Technical issue. Visible now? Not yet.
No, not yet visible.
Okay. Let me try once more, sir. Just give me a minute.
Is it
Seems your
now?
content is no, your content is not loading. Okay. So
It's showing only starting to share the content. Yeah. Yes, now it's came. Keeping on the slideshow.
Is it now in the slideshow?
yes,
From it?
yes,
Yes.
yeah,
Yes.
yeah.
Okay.
Not a
Okay.
slideshow,
Okay.
but slide is visible. Make it a slideshow, Kapil. Yeah.
Is it now?
No, still it is not. It is not in the slideshow.
We did it. Some technical issue. I don't know what's happening.
Kapil, you can continue with this. No issues.
Yeah, yeah. Please continue, Kapil. Yeah. It's okay. Fine. Please continue.
Okay. Okay. So, sorry for this little technical glitch. Actually, I would just like to cover quickly that what exactly hedging is, what are the market uncertainties which can impact the prices, how it can be managed using derivatives market, how do we see global market performing on this aspect. Maybe few points I would like to quickly cover that why do people don't hedge and what are the things which they consider for not hedging and how quickly you can start and move into this hedging thing. So hedging is actually nothing. It's just to manage the uncertainty which may have uh, on the various aspect, right? When we say hedging, it's not only related to the financial market that we need to hedge ourselves. Yes, mostly it's being used for the derivatives market, but actually the kind of uncertainty we have in any aspect of our life, whether it's life and whether it's our business, to manage it some way is basically hedging. And I think we all are somehow engaged in various kind of hedging for our personal, for our commercial reasons. If we go the recent thing, right? So I think the best example how we have quickly responded to uncertainty is the COVID time, right? When COVID started, we have a lot of uncertainty about our health, about our well-being, about our protection, and I think these all measures quickly came into the picture, and we started using this, whether it's using of mask, sanitizer, washing hand, distance, disinfection, quarantine, and now finally vaccine. So somehow the uncertainty which comes and which creates risk for us, immediately something which we look forward is the hedging. And I think this is the best way we can right now project how we are hedging ourselves against the uncertainty which COVID is creating in our life. And I think similar thing is exists aspect of our life, uh, whether it's our wealth and the business we are into and the health we have seen. And if you see, after post-COVID, the life insurance and health insurance have seen a sharp jump of close to 20 and 35%. Means now seeing uncertainty, a lot of people have come forward and started taking some kind of measures which can, reduce the uncertainty or can make life little more secure using life insurance and health insurance. But when it comes to wealth, especially the business we are into, the uncertainty which can be, multiple, not only the fundamental which Sumit will discuss, various other aspects, how what we are doing to protect that. And I think that is something which we are discussing here, that what exactly is this. So we know that prices are driven by the demand supply. We being the industry participants most of the time have a fair idea that how the demand supply situation is and how prices may behave going forward, with sometime more accuracy, sometime less accuracy. But the point here is that something always there which impact the entire scenario, which we have not considered while doing our demand supply and price analysis. It may be the drought we have seen. It may be a trade war, geopolitical situation we never predicted, we never expected, but had a huge impact. It, the biofuel uses everybody is talking about. It may be container shortages. We haven't seen kind of situation we are seeing now. Even today, I was reading that 300 ships are lining up somewhere to get loaded. And of course, something which was even out of context, like Suez Canal block. A ship blocked in the Suez Canal and the commodity prices were volatile, and almost every commodity was impacted. So the point here is we do not know what uncertainty will bring what to the prices. But yes, when prices moves, we have a risk, whether prices move upside, whether prices move downside. It creates uncertainty to our business, and especially the business where we are, where raw material contributes 80 to 90% of our uh, output price. And if anything happens on that side, I think it becomes difficult to manage the uh, prices and to manage the margin of the business we are into. Are my slides moving? So
No, we are
No, I'm just supposed to complete your waiting for your pause. Your slides are not moving.
we can see only first
Not
slide.
moving.
Yeah.
Yeah, I was just waiting for your pause. You are talking in the. I just thought let's you take pause. First slide only. Now it is showing your recent uncertainty slide. I don't know which number. This is number slide 6 number slide.
okay, so you can see the recent uncertainty. I think this is the slide I was talking about,
Yeah.
that what can lead to the price uncertainty, and that we all know. Next slide is visible, impact of uncertainty.
No, Kapil. It is still recent uncertainty only. Yeah, now it is coming, but pictures are not there. Just you.
Are these their pictures?
Yeah. Now it is clear. Yes.
Okay. Okay, perfect. I think it's going a little slow than
Yeah.
my click.
Yeah.
So,
Yeah.
so when we talk about uncertainty, of course, it has some impact. And these are some news headlines which I have captured from recent past. And it mentioned that how this uncertainty impacts prices of our industry. Right, so we'll start with feed cost affecting the poultry market. Chicken to get more expensive, India's heat wave kills birds. Social media rumors impact poultry and feed sectors. And simultaneously, many other things. In 2021, of course, we have seen COVID, uh, poultry sector in trouble for the third time in 14 months on COVID surge, and then animal feed cost is impacting the industry. So uncertainty brings a risk to us. Sometimes it may be in our favor that prices are going down, raw material is less costlier, what we thought, but this remains consistent if we are having a proper tool to manage these uncertainty. And sometime it may go in your favor, sometime may go in against you. But as an industry, I think it's always good to beat the uncertainty and draw a line that beyond this we are managed, and anything happens to the raw material prices, we are in a perfect position to manage that, and we are in a perfect position to keep our margin intact and keep our bottom line strong, as we thought once the year started. So now the next thing is, can we manage this uncertainty in the business we are? And this slide I have kept considering the audience we have here. Is it slide visible, Sujit ji? These two graphs?
No, it is still impact of uncertainty, not graph. Still, you are at the impact of uncertainty slide. That is 2007 to 2021. Yeah, now the graphs slide has came. Maize and soya DOC graph.
Okay. Clear, yes. So now the question comes, can we manage this uncertainty of the raw material prices through our output? Can we just pass on this to our customer? And these two charts we have, this is the information we could collect, where we have kept maize prices and two of the major output of poultry, which is egg and chicken prices, and the soya DOC and the same egg and chicken prices. And what you see in these two slides, there are certain points when there is a negative correlation. Means the prices have moved sharply. If you see the first
Kapil,
chart,
sorry
where
to
maize is
interrupt
there.
you. Can you make it on the slideshow? Numbers cannot be. Yeah, that's better. Yeah, this.
Is it now slideshow?
Yeah, it's clear. Yeah, please.
Okay. Yeah.
Yes.
So in case of maize, if you see July 19, September 19, May 19, that period, I think when the COVID first hit us, lockdown, we have seen sharp fall in the chicken prices. But on the other hand, if you see the raw material prices, which is maize, have sharply moved up because of various reasons, factors we know now. But there are situations when raw material kept increasing and output prices was not in sync to the raw material prices. Means that uncertainty or risk we have in the raw material prices always cannot be adjusted to the output prices. And that's the risk we carry as an industry, where margin is impacted by the high volatility in the raw material prices. And this is only one. If you see, there were multiple instances where raw material and output have not moved in tandem. And I think if you look at the soya DOC now, how the things are moving up, I think we all know what's happening with the soya DOC prices and what's happening to the chicken. We don't have chicken prices for that, but the egg prices at least we do have. And so these are two conditions which says that any volatility which happens on the raw material cannot be into the output prices. And when this situation becomes too volatile, that has a direct impact on the margin of the industry, and that's what these two chart depicts. So these things really lead us to think of that what can we do to manage these uncertainty where our raw material price is intact, and similarly in that relation our output prices are very balancedly priced, and our profit margin, the margin on which industry is operating, is intact. So the first thing is, should we to the customer? Sometimes we can do it, sometimes we cannot do it, and we have seen that in those two charts that it's not always possible. Then we have forward contract, where we have forward agreement in the physical market. We do carry our huge inventory to make sure that our raw material prices is not, and any kind of volatility, especially prices moving up, is not impacting us, and we are protected. But that has various other risks, inventory risk, managing risk, prices falling risk. And sometimes we do have forward contract where we go and do some forward contract for raw material supply. But that bilateral trade also brings a lot of uncertainty. If prices moves beyond certain point, volatility is high, there may be counterparty risk, there may be liquidity risk, and there may be various other risks we all know. And then, of course, third is the hedging, which we are talking about, where we can use some financial derivatives tools available, and using them, we can manage those risks scientifically, efficiently, and in a much more transparent way. So what hedging is actually, right? Is it trading? Is it making some speculative trade? Is it just going to the exchange and buying? What exactly is? So this is basically do some kind of trade using derivatives market to neutralize the adverse price movement which may happen. And it's kind of, locking prices for your raw material for today, for tomorrow, and maybe beyond that, next 4, 5, 6 months, and making it sure that we are sure about the price of raw material and we are sure about the supply of raw material. Those uncertainties now we are out of, and we can purely think of doing our business in which we are into. So this is being
Kapil,
done
sorry to
using
interrupt you.
very well.
You have one more minute or max 2 minutes, please, because of time technical issues. Yeah.
Yes,
Please.
yes. I am almost done. So how it helps you? It helps you in capital protection and optimization. You can plan better your inventory, your futures purchase, your future sale, everything. You have a strategic advantage if you are hedged in comparison to your competition. Your raw material prices is well priced, and accordingly your output prices can be much better than what your competition is doing. And of course, cash flow stability is always there if you are financially hedged. There are certain questions that why don't people hedge? Yes, there is still a lot of thoughts that why do not people hedge if this market is so efficient, this market offers so much of value to the market participants, why don't they hedge? So yes, there is an issue of knowledge and awareness. Still people think that this is a speculative market, it's a gambling market and there is nothing for us. But I would rather say globally, we have seen these derivatives market are dominated by the hedgers, and they are the people who carry most of the position any point of the time. Second point comes is a costly affairs. Yes, many people say it's very costly. Hedging is a costly affairs, but if you see the impact any of the adverse price movement can have either in your inventory, either in your raw material price, and vis-a-vis the cost of hedging, it's nothing, and this is visible on the slide. And the most important thing, the last is opportunity loss. Many people do think if we lock a one price, and if that price moves in our favor, then we will be losing the huge opportunity if we do hedge. But the point maybe once in a while, but your business needs to be run profitably and sustainability for a longer period of time. So this opportunity loss can, of course, make you some good money, but the risk which price uncertainty brings you is forever at any point of time. So these are certain points why people do think that not hedge and they don't hedge. These are some spot price correlation. I will just skip it. Rajni will cover it. So it's how to get a start. So just you need to open an account for hedging. The brokers and the members of exchange will help you out how to design the hedging strategy, how to have the hedge policy, what are the rules and regulations for hedging, and then with the help of all the knowledge you already have on the fundamental of the market, you can start doing hedging. So with this, I will stop here. Mr. Sujit, thanks for the patience listening, all of you.
Thank you, Kapil. I think it is a good introduction, and maybe in coming days and in timeline of the coming months, we can definitely highlight more on the hedging and knowledge. And behalf of CLAFMA and NCDEX, again, I sincerely apologize for some technical difficulties. This is limitations. This is the concern. Generally, personally, I also never really enjoy online too much activities, but we have to cope up. You have to cope up with this. So hope that hereafter it will be not any issue. So before inviting the next speaker and panelist, I would like to introduce. So our next panelist is Mr. Sumit Gupta. Sumit Gupta is business head South Asia and Southeast Asia for McDonald Pales. He's a 17 years experience in commodity business. Mr. Sumit also worked with Cargill Commodity and also Olam Singapore, one of the Asian largest commodity business organization. His vast experience in international and domestic market for hedging and risk management, and also he's having graduate from the IFFT from Delhi. So I would like to request Sumit to highlight on the international and domestic perspective of hedging and risk management. I also request all participants that please feel free to write questions. A few questions I can see, and please feel free that whatever you feel questions, and we'll take up at the end of the session.
Hi, good evening, everyone. Is it audible? Is it a good connection?
Yes.
And screen is
your slide is also appearing now clear. Yeah.
Yeah, perfect. Thank you very much, sir, for such an informative presentation and introduction after that. Thank you very much. And I'm glad to be part of such a knowledgeable panel and attendees who I'm sure are looking forward to the basic question on why the price movement of soya and corn, the way it happened last year, is going to continue and how it is impacting their business. To begin with, there is a famous statement by Donald Rumsfeld. He said, there are known knowns, there are known unknowns. So today's presentation is about discussing known knowns, okay? The idea behind this presentation is to bring out as many fundamentals factors as possible to the light of the group so that we can make informative decisions. So Kapil ji, during his presentation, mentioned a couple of times that people correlate hedging with gambling, because when you don't put research in front of hedging, you take unknown risk, you actually maximize the unknown risk. And because of that, it becomes gambling. Rather, I'll put this way, the more research, the more informative we become about the global market, the better it is. Because in that way, we take known risk and we reduce the number of unknown risks. As mentioned, commodity risk is anything which adversely affect the business performance. And last 2 years, because of COVID, initially in March 2020, and henceforth from August 2020 onwards on soya prices have been particularly volatile for the commodities and commodities participants. And it has brought a very important aspect in front of us, that how we need to hedge ourselves against the price risk movement of commodities, or do we need to hedge ourselves for the price risk commodities? And to bring this aspect, we have in this presentation looked at all the fundamental factors. India, as we know, is impacted by El Nino weather pattern, which means whenever there is a El Nino, there is less rain in India. And when there is a less rain in India, Indian production relatively goes down for corn and soybean, because both are dominantly Kharif crops. And during La Nina phase, we get good rainfall in Kharif season, and hence we get bountiful of soybean and corn crop. But it impacts US and South America in a different way. In El Nino years, we get good crop in US and South America. And in La Nina years, we get relatively poorer crop or poorer rainfall in South America and US. And last year was a La Nina year. What does it mean? That means we had relatively okay crops in India, but less crops in US and South America, which has led to price rally in the domestic markets. And because Indian goods were competitive in international market, because global prices have started moving up. So it takes us to a question: if our production goes down in El Nino years and global production is up and we cannot import, and in our production goes up in La Nina years and we export, what it means for the consumer? It means for the consumer that we are going to live in volatile environment forever, whether it's a El Nino year or La Nina year. Especially for Indian commodities like soybean, which we cannot import from anywhere except Africa because of GMO, non-GMO constraint. And the way our domestic demand is growing as against the domestic supply, we are going to stay in a very volatile environment in years to come. So this year is not an exception, or this year will not just go away. This year is a precursor for many years, which we are going to see henceforth in soybean, because global ending stocks of soybeans have become relatively tight, and we have to look towards sun god every year in terms of production. This is the corn global situation. If you look this year, global production was, when I'm saying this year, year 2020-21, and crop year is September 1st, August 31. So this year, global production was 1125 million tons. And we expect next year production to be 1190 million tons. That means we expect production to go up by 55 million tons or 65 million tons. And to offset the increasing demand, demand is going to come back because of biofuels, because of the feed ration demand, because of higher demand in China and EU. And this means that we have to have a bumper production in US, and we need to have big production in Argentina, Brazil, and Ukraine. What does that mean? It means when US is in planting phase right now, US planting window is from April till September. So that means we need to have a bigger crop in US. If US crop, something happens to US weather, or US weather becomes more unpredictable, or there is a dryness or heat in the US weather, that means the production potential will go down and global prices will become extremely volatile. Even with this jump in production, we are not increasing ending stock, and which is where the entire gambit lies. That means outside China, we are not adding any ending stock. And because of that, global prices or global supply of corn is going to remain tight. And that puts India in a very particular or very peculiar situation where India can be a net exporter of corn, and it is very difficult for to import corn because India is one of the cheapest countries right now as far as corn prices is concerned. And because of that, when India export corn, domestic corn industry will find it difficult to source corn, and domestic prices of corn will become fairly and very volatile. This is the price volatility of corn globally. From last year, same month, April to April, corn prices have gone up by 100%, almost 100% in US. What does it mean? It means that this rally on corn price was worldwide. It happened everywhere. Apart from the corn price only, the freight market has also moved up. That means the freight, which was around $36 last year from Argentina to Vietnam, is around $70 right now. So that means destinations like Vietnam are paying much higher price this year than they were paying last year. Thanks to Indian farmer, thanks to research in the maize that has happened over many years, Indian corn yield is consistently going up. And because of that, we have been able to meet the domestic industry demand, which is growing both in the starch and the poultry segment. And thankfully, because of good weather, research in seed technology, good farming practices, we have been able to keep ourselves self-sufficient and will be exporting almost 2.2 to 2.5 million tons of corn this year. And that will mean that as we will get into July and August, corn prices are going to become very volatile in India, in domestic markets. So we will come to the reasons where it will become volatile and why. So this price escalation and price volatility was not a factor which was limited to India. This factor has impacted industry globally everywhere. If you look at the corn prices, rally has been actually induced by China. China domestic market flared up on corn because of the shortage of the feed grains, because of their stocking plan and government auction system. And China imported 26 million tons of corn this year as against 6 million tons last year. As per various estimates, China will end up importing around 35 million tons of corn this year, and approximately they will import somewhere between 25 to 35 million tons of corn in the coming year also. That means China has become one of the biggest importer of corn worldwide from virtually a non-participant. And this means that global situation or this new demand is going to keep global supplies tight. It means that Vietnam, Bangladesh, and the countries nearby India will be dependent on India for corn. They will look towards Indian supplies. That will mean for the Indian feed users or the feed producers, the corn prices are going to stay volatile. They will always have to see how the global factors are moving. And right now it is not in the favor because global demand look towards recovery. Post-COVID, Europe is expected to increase its demand and which put overall demand picture for the coming year in a better position than it was last year. This is the corn S&D that we have for this year. We expect very tight carry out. From last 3-4 years, carry out was relatively comfortable, so that was never a supply issue. This year, though, our production has gone up, but our exports are also expected to go up to 2.5 million tons approximately, which is dominantly to Vietnam and Bangladesh. So our ending stock will be virtually zero as we will get into new crop in September, or rather October, November. That means the period between August and September, October is going to be very volatile, and we will have to both look towards the supply and price security. We have defined the reason why the prices of corn is going to stay or the export demand is going to stay vibrant, because Bangladesh is going to import approximately 2 million tons, Malaysia 4, and Vietnam 13 million tons of corn. So total demand of corn in the region is around 23 million tons. And India only needs to export a couple of million tons to make domestic S&D very tight. Indian starch industry and feed industry has done fantastic work as far as growth of demand is concerned. Starch industry has almost doubled itself in last 10 years, and similarly poultry industry demand of corn has almost doubled itself in last 12 years. So which means there is a secular growth rate between 6 to 8% year on year. And the competition from soybean this year on acreage is going to make corn farmer opt for soybean, and next year crop is going to be a key driver of how we are going to see the prices. Plus, the global price situation is not looking to ease off in a short term, and that is where we expect Vietnam and Bangladesh to continuously import corn from India. There is a very interesting Bihar and Brazil connection. Actually, Bangladesh imports most of its corn from August till December, Jan from Brazil. This year, as you know, Brazil production is expected to be down from 105 million tons to approximately 90 million tons, 91 million tons. Keeping that in mind, this year, the prices of corn into Bangladesh is around $330 CFR at the moment. As against that, we can today, corn from Bihar is landing into Bangladesh at $230, $240 CFR into Bangladesh. So there is a possibility of prices may go up by $50 to $70 per metric ton only basis Bangladesh, because Bangladesh will always opt for Indian corn, which is much cheaper than Brazilian corn. So looking at the global situation at the moment, we should not expect, especially in east of India, Odisha, Bihar, Bangladesh, West Bengal, UP prices to ease off. Rather, we should expect prices to stay very firm from now till next year new crop, which will come in April. So especially for East and South India consumer, the price security this year is going to be of vital importance. India is going to export both by bulk vessels, containers, and rail cars and trucks. The total export we expect 2.5 million tons. Out of that, 1.5 million tons will happen by rail cars and trucks to Bangladesh, and approximately 1 million ton by vessels and containers to Vietnam. So for Vietnam, out of 13 million tons to import 1 million ton from India is nothing. But for India to export 1 million ton to Vietnam is a lot. So that is where when S&D becomes very balanced, a small change in the in demand can make a big difference in price, and it can make it very volatile. And that is the reason, if we look at the fundamental factors in a very plain sense, the prices are going to stay very volatile in the coming year, or going to stay volatile in the months ahead. This is the SOPA S&D. SOPA expect around 25 lakh tons of soybean is still with Indian farmer, which is difficult to believe looking at the price action. And SOPA believes that the ending stock will be around 100,000 tons, which will be around 1 lakh tons towards September 30. 1 lakh tons in a production of 10 million tons is nothing, is virtually equivalent to zero. And that is one reason why Indian soybean prices have become so volatile. The world soybean supply and use is going to stay tight in the coming year also. We expect the ending stocks not to increase anywhere in the world. And there is a larger pressure on Brazil to produce more. USDA expect Brazil to produce 7 to 8 million tons of more soybeans to take care of the rising demand. So weather factors are going to keep soybean supply and demand situation very volatile. Plus the oil blending is the other factor. The green budgeting is the other factor, which is making the soybean prices quite firm across the world. So looking at these factors, China is going to import coming year around 119 million tons of soybeans as against 114 million tons this year. So overall global supply and demand situation is going to stay very balanced to tight. But one factor which is going to help reduce volatility in soybean prices is there will be a potentially better crop of sunflower seed and rapeseed this year. There will be a higher crop of rapeseed in Australia, which will ease off pressure on the vegetable oils. And hence, soybean prices may cool off a bit in the coming year. But these are just the assumptions. We'll have to keep a very close look on Australian weather, European weather, US and Brazilian weather to make out that how the situation evolves here henceforth from here on. Till March, month on month, if you see in US, soybean prices have gone up by around 50%. In April and May, we saw further rally. So soybean prices in US have gone up by around 75 to 80% in last 1 year, which is also reflected in the Indian market. Indian prices have also rallied for almost the same price. Soybean prices have gone up by 40%. The basis is not reflected because US crushers were crushing for oil because of the blending margin. Blending margin this year was around $500 higher than what Argentinian farmer was getting. And that is the reason soya meal prices have not rallied as much, because larger share of crushing went to the oil. And soybean price rally was reflected in the vegetable oil price rally, and soybean meal prices relatively stayed flat to attract the demand. And this is also reflected in the prices in India. But India is a very difficult situation that we can export, but we cannot import. Last year, we imported around 5 million tons of sunflower meal also, which we are not able to do this year because China is already paying $400 CFR for sunflower meal. And there is a duty of around 16% on sunflower meal imports in India. So in a year when we produce more, we end up exporting, and our domestic market becomes very volatile, and it becomes difficult for our end users to secure their supplies or to secure their supply management. That is one reason that or one factor that we will have to look for long-term policy changes where India should be in position to export and import, because till the time that will not happen, Indian domestic industry prices will remain very firm. This is month-on-month chart of how the soybean prices and corn prices have changed. If you look between 2015 to 2019 markets, there were very few green months, hardly any green month. That means market stayed very flat for last 5 years. But since 2020-21, if you see, most of the months are green months. That means prices have rallied over their previous month. And that has happened because of bad weather in Brazil, poor weather in Europe, relatively less production in US, and much higher demand in China. These all factors contributed to price rally across the board in feed grains and oil seeds. And that is reflected in the prices. So what is in store for us is going to be decided by how June and July weather acts in US, how we see the Brazilian weather shaping up towards September and October for soybeans, and how China behaves. The way global freights are, India is very attractive option to ship cargo from India at the moment. This is one slide which captures the entire problem of soya sector in India. From last 20 years, our yield is constant. In 2000, our yield was 0.8 tons, 0.9 metric tons per hectare. In 2022-1, our yield is 0.88 metric ton per hectare. So a country of 1.33 billion people, area increase is not a solution. Solution is yield increase, and we have to see how we are going to increase. We have to look towards the extension activities, and the solution is only going to come if we are going to increase yield in our domestic in soybean sector. If yield is not going to increase, then soya industry in India will not or may not be able to stay self-sufficient in the months and the years to come. The total demand of soybean has gone up from 1.3 million tons to 6.2 million tons in total in last 20 years. As against that, we can see the exports have gone down, and the total supply side has not changed much. So what does it mean? It means the domestic industry finds it difficult to source now, and that is where from the price risk it has also become a supply risk. So at some point in time, the solution for this problem does not only lies in the price management, it also lies how we do the extension activity, how we go for higher yielding varieties of seed, and potentially how we can push farmers or we can incentivize farmer to increase the acreage under soybean, which I don't believe is a long-term solution, but increasing the yield is a more probable solution. Then coming to uncertainty of monsoon, in last few years we have seen the uncertainty of monsoon has gone up because of the uncertainty of monsoon, which is because of the spread, intensity, duration, and quantity of monsoon. It changes the production dynamics, and that is where I come to the summary of the presentation. That coming year is also going to stay very volatile. US weather is critical factor in next 90 days. USDA in terms of production is banking a lot on Brazil for soya and corn production increase. Post-COVID demand is coming back in EU and rest of the world. Veg oils and green budgeting will be a big reason for soybeans price escalation in the coming year. Monsoon to 2021 has to perform very well for on the oilseed area especially. We need to watch all these factors. Plus, Bangladesh will remain dependent on corn on India, and may lead to price escalation in Bihar and east of India, east part of the country. So overall, looking at these factors, I hope we'll be able to throw more light and made a lot of unknown factors known to the group. And that was the intention of the presentation. Thank you very much.
Really, thank you very much, Sumit. I think very deep dive and insight on the what is present global, even South Asian and Asian market about the. Oh, we received a few interesting questions, Sumit. I think I'll personally also like to hear your comments. But we take at the end of the all session, all the speakers, panelists. So next panelist I would like to invite. He's also very much experienced, more than 16 years experience. He's associated with the ITC last 16 years. He's instrumental in setting up the derivatives desk at ITC, actively involved in internal risk management framework and policy. And his learning and experience on the hedging and risk management definitely give the valuable insight or in for our participants. So Mr. Rajib Saha from ITC.
Hi, good afternoon, Mr. Sujit.
Yeah.
Voice audible?
Yeah, audible. You can start your camera. So yeah, please.
Yeah, good afternoon to all the participants and to the chairman and Mr. Sujit and also my co-panelist. So far, we have seen very good presentations from Kapil and also from Mr. Sumit, highlighting the details of hedging and this futures market, and also about the perspective of the global market of important ingredients for the feed industry like corn and soya meal. Like I'm closing my video because there are certain connectivity issue. I think video will take more bandwidth.
But it's okay, Rajib sir. I think Rajib,
Yeah. I don't.
If anything is, you can keep your video on. That is looks more live.
Okay.
And if
Okay.
echo or some issues, I will
because
interrupt
my
you.
voice was getting disruptive,
No,
so I thought
it's
maybe
fine. It's fine. Anytime if it is echoing, I will interrupt you. Yeah, I will interrupt you.
Okay. So ITC, I have joined ITC in 2003, and since then ITC is actively into risk management of commodities. As you may be aware that we are dealing into agri commodities like soybean, soya meal, rice, coffee, and also maize and other like mustard, chana, spices. So all these commodities like oil seeds, grains, spices, these are highly volatile. Now, as a corporate, when you are making your annual plan and you are budgeting some numbers, like you are budgeting your purchase number, how much you are going to procure, how much you are going to sell, in which quarter, how much quantity you are going to purchase, sell, and therefore what is the profitability and business income. Everything in a corporate is plan driven or a quarter driven or a week to week basis driven, where ultimately at the end of the quarter or end of the year, you have to give or show your performance to your shareholder, to the market. So, but you have seen the kind of volatility in the market, kind of uncertainty in the prices. Now, a company or an organization who is buying, say, soybean or exporting soya meal, or maybe making into of feed, poultry feed, and they need to buy, say, 20,000, 50,000 tons of maize every month. So for that kind of company organization to make a yearly plan, to make a quarterly plan and deliver is impossible with this kind of price action and the kind of price volatility we have seen of late in the market. So therefore, the importance of risk management comes very handy. Like, unless you hedge your risk, your uncertainty about the price, your raw material price, which you are going to procure maybe down the line 3 months later, 6 months later, 4 months later, if you are not priced that, or if you are not sure, then you are not sure about any of your number, that how much you are going to purchase, at what price, how you are going to sell, whom you are going to sell, whether there will be a buyer at that price. So therefore, there lies the crux, and risk management of price is very, very important at this juncture. It has become all the more important because of the highest level of volatility. I have not seen this kind of volatility in the market for last 15 years. I have not seen. The unforeseen movement in soya bean or soya oil, like Sumit was giving the example, if you see the chart of soya oil, it was last year June, it was trading at 29 cents or 28 cents. And last week it was trading at 73 or 74 cents. You can see the multi-fold jump. Like, if you take the example of soybean, Indian soybean, we all know the prices from 38 rupees, it has gone to almost 80 rupees. And it is almost a one-sided movement. Similarly, for US soybean, if you see, it was trading at 8.5 cents per bushel last year at this time, June. And whereas current year, it has gone to almost 16 or 17 cents. So therefore, these are the unprecedented movement of commodities, and therefore it is all the more important to utilize risk management for a corporate, for a company who are into commodities. Now, there are various factors which are the guiding principle or affecting the commodity prices, like economic growth of a country, various geopolitical development in and around that country, and also various government actions like import, export, tariff barrier, minimum export, maximum export, MSP, government procurement. So these are various government action, and also the movement of currency, like how a currency is getting appreciated or depreciated. And also the fifth factor is, or a very important factor, is weather. Weather is very, very uncertain factor, and the way weather plays its role, which will be more visible currently because the monsoon is approaching. And as soon as the monsoon reaches our soybean and corn areas, you can see the markets becoming more volatile. And also the sixth biggest factor is the hedge fund. Like we have seen globally, the it has commodities have become an alternate investment area, and in India also there are a lot of hedge funds are coming out and trying to utilize this commodities market. So therefore, hedge funds are also an important factor which influences the commodity prices and commodity markets. Now, I'll tell you more something about, like, there are, as Kapil told, like you have soybean, soya meal, and maize contracts. Now, as a user or a poultry industry, you are the user of all these ingredients. Now, so therefore, it is important, like how you protect your price. Like you want to buy soya meal down the line 2 months, or you have to buy soya bean and then crush. So therefore, how to price it? So utilization of futures, like taking a buy position in futures market, will give you two protection. One is a price protection. Second is a counterparty protection, because it's a contract which is regulated on the exchange platform. Exchange and exchange settlement mechanism is there who are going to secure your trade. Thirdly, it is a leverage position. That means you don't have to block your the entire capital requirement. It's a leverage position. That means you have to only pay the margin money and you can secure your price. So therefore, instead of buying the raw material itself and waiting for the price to go up, or if you are making a contract and today only you are trying to procure the entire raw material, then it is a capital intensive strategy, whereas you can utilize this market or the futures market, where you can take the leverage position through paying margin and take a buy position, and accordingly, as and when you do your procurement in the physical, you can square off in futures market. Now, as an organization, I mean, hedging doesn't come overnight. It is an organization culture where the entire organization, right from the top management to the bottom, to the procurement team, everybody has to be lined up and they have to be aligned with the policy. You have to have one internal risk management policy, and which recognizes hedging as a valid strategy, and therefore your top management to entire your execution team, everybody is aware what are the rules, what to be done at what situation, who are the people who are going to take the position, and how much each trader is permitted to take position. So everything is documented in a risk management or a hedging policy. Therefore, it is the Bible for any organization who is thinking for risk management or going through efficient price risk management through hedging. So therefore, it is to begin with, you have to know the best practices, the rules of the game, and then you have to formulate your internal risk management policy, where everything will be documented as per the policy and as per the situation. Who is going to take what call, how much, what quantity is permitted, which exchange is permitted, what kind of instrument. There are various instruments currently available, like futures are available, options are available, index is available. You can go to a over, like for palm, or for CBOT, for soybean, soya meal. So therefore, everything has to be documented, and then only you should go and proceed for your hedging. One more thing I want to highlight or maybe bring in here, like it is like every time there is a price rise, the futures markets are always been targeted or known, I mean, highlighted that one of the reason that it is a speculation going on there and the prices are going up. Now, prices are going up or coming down is the action of the participants who are trading or following that market. So it is not the market or the platform or the instrument that it is good or bad. It is the participants and their intuition or their knowledge that is going to reflect or reflecting in the price action. Now, more and more people like you who are dealing into commodities day in, day out, they become a participant in this trade, and more the volume, more the depth in this market, it increases, then it is more likely that this market will be more aligned to the physical reality. Now, currently, the futures markets are governed by SEBI and the contract design and delivery centers, and how much you can trade, what is the margin. Everything is governed by SEBI as well as NCDEX, and NCDEX in consultation with the product management committee. Like in that, the various participants like traders, brokers, importers, exporters, feed manufacturers, all these people are there in the product management committee who gives their recommendations and the way the contract has to be designed. Now, I would like to urge like more and more people come forward and take interest about this market, so that the product which is getting traded or which is getting made by exchange like futures contract or an option contract, they become more robust, they become more market friendly, and also it is more closer to the reality of the physical market. Then only the contracts will be aligned, prices will be aligned. One more thing I would like to, one more perspective I'd like to bring is hedging is also not risk free. Like everybody is talking that hedging means risk management. Risk management means you are free from the risk. It is not, but it is definitely a lesser risk model or a technique you are going to adopt. So by hedging, that means if you have a requirement of 100 tons of soybean or soy meal next month, and you are taking a buy position, that means you are converting your flat price risk to a basis price risk. That means, uh, suppose 1 month later, the price of that 100 tons becomes 72,000, and today you have bought that at 71,000. So therefore, you are securing your price at 71,000. But at the 1 month period later, when you physically buy that material, so there will be a price difference from physical market to futures market. That is called basis. But you are not open to the 100% volatility of the market. You are only exposed to the basis risk, which is a futures and spot price risk. So that means you are converting your 100% open risk to maybe a 2% or 5% basis risk. Secondly, it is the contract designs you need to study. Like you can take a buy position, you can take a sell position. There are delivery centers, you can take physical delivery also. So, and therefore you can de-risk your business. But again, the contract designs are not error free. You more and more people have to participate in this. Thirdly, the liquidity risk. Like exchanges are not very liquid in many contracts. Like in maize, you may see that volumes and open interest are not that great. But whereas in soybean, it is more. So that means more people are participating in soybean, whereas very less people are participating in maize. So more you make this market liquid, and this platform will become more robust for risk management. International markets, you have seen the depth, open interest, volume. There are 100 lakhs people. I mean, open interest is there, and all big and small companies, everybody follow that prices. So therefore, it has become a well-developed risk management platform and market. So these are the top of.
I think we have to. Yeah. Please, last comment. Yeah.
So, I mean, also my last point I would like to say is you may not directly participate in futures market, but futures market gives a lot of indication. If you start following the price action, you start following the price difference between first month, second month, third month, the basis of spot and futures difference, what is the stock in the exchange go down. All these will give you some clue, and these clues can be very, very important for your business decision. So try to utilize this market directly or indirectly more, and you participate more in terms of construction of this market contracts, and also incorporate these risk management practices as a habit in your organization. Thank you.
Thank you, Rajib. I think very, very nicely. I think best part of your speech is the way you summarized, Rajib. I think that is the really, I personally like it, because you said very clearly that okay, even if you do practically hedging or option, but if you are studying and if you are part of this process and understand this risk management, at least our industry can get some indication of this uncertainty. And present scenario, I think minimizing the losses or minimizing the risk, that is also very challenging in the derivatives or commodities, particularly corn and soya, where more than 80% our feed is depends on these ingredients. Thank you, Rajib. Maybe end of the session, you can comment a few questions. Take. So, thank you. Before inviting next and this is last speaker, we have. Before introducing the final speaker, I'll request all participants to stay for another 20 minutes or 30 minutes, because after this 15 minutes presentation of Rajni, we can get some interesting questions. We received few questions, and that might be, you can also think of same question line or on the same track, whether you can get answer from these expert and huge experts from the Sumit Gupta, Rajib Shah, Rajni and Kapil Dev. So I'd like to invite the next speaker, who is 20 years experience, more than 20 years experience in India and global commodity markets. She's Vice President and Head for Commodities Division at Philip Commodities. She has done her master's degree in economics from the Bombay University. And it is really amazing to see that around more than 20 years, she's working with this Philip Commodities, the same organization, for last 2 decades. So her name is Rajni Panikar. So Rajni Panikar, the floor is yours, please. Rajni, you are not audible.
Is it any better? Can you hear me?
Yeah. Clear, very clear.
Can you see the screen of a case study on the screen?
Just it is a heading title. I can see case study, and it is not in the slideshow.
Yeah.
You make it slideshow, and I can just see the only title as a case study.
Right. It's. I mean, I want. Okay. I want it like this because so much has been. Okay. I mean, before I.
Yeah, Rajni, just quick request to you. You have exactly 15 minutes, Rajni.
Okay, I will try to take 10.
Yeah, sure.
Okay. So much has been discussed. So much has been discussed this evening that it makes my job actually very easy. I think the presentation that Kapil started with the need for hedging, which was then followed up by Sumit, as to given all the unknowns, it just strengthened the case as to why hedging is required. And of course, from ITC, which is a pioneer of hedging, to get that very insight as to what is required, how to even participate in it, even if you are not actively trading, but to take the price signals from the futures market, which is essentially the platform for price discovery. And the price discovery on the futures will always be more efficient rather than your spot market traders giving you that price for corn or soy meal, because what you can't take away from the exchange is the fact that the price discovery on the exchange is pan-India. It is not localized like the spot market. So it's a very good price discovery platform, and that should definitely be incorporated as a price signal for your procurement requirements. So I think, having said all this, I don't have to repeat what all the elite panelists did share. As Kapil said in his presentation, Phillip Capital, the role that it plays in an exchange platform is that of a member of the exchange. So whichever participant tomorrow decides to participate on the exchange by taking a small position for hedging, just for when the hedging activity, it has to come through a member like Phillip Capital. And Phillip Capital have been members on NCDEX as well as most global exchange platforms. In India, we have the unique recognition that we've been members since inception. And that is why we have worked with a lot of corporates, lot of plants, lot of small traders who have constantly, the different value chain participants who constantly get exposed to price volatility, because that is the nature of commodity markets. So having worked for
Rajni, sorry to disturb. Still, it is not in slideshow, and still the same title
yes,
is.
I'm just yes, Sujit.
Okay.
I'm just giving an introduction because I don't want to go through all the repetition. So I will just
yeah.
Sorry. So over the years, we have worked, like I said, with various value chain participants, sometimes just simple executing because they already know what they want to do. Like Rajiv ji said from ITC, their risk policy is in place. So they know exactly what has to be purchased at what time, which months. So right from corporates such as who are well established with the principles of price risk management hedging, to as much as a trader who has just come in because he's sitting with a stock of soybeans. For him, the capital expense that he has spent in buying that soybeans and stocking it in a warehouse is huge. He is just looking for some kind of price protection. So we have advised such traders as well. So we have therefore what we would like to send out as a message is that we work with various participants in fulfilling whatever is the reason that they want to access the exchange platform for. Starting from price risk management or a procurement enhancement strategy, whatever the requirements. We have been working for many years in hand-holding such participants. And so much has been said today on the recent soybean volatility that I did not, like I was telling Sujit also, didn't want to repeat the entire thing. What I just wanted to show was a small case study that is an actual market price analysis that I would like to share for a plant. Just a bit. Yes. So this is for a small plant, not really, quite a mid-sized plant, who had come to us somewhere in about November of 2020. They wanted to hedge 20% of their monthly soybean purchases, which was around 8,000 metric tons or so. I mean, you need not focus on, the size of the plant, how much was to be hedged. The idea is that this is something that we did in November of 2020 for a plant who wanted to hedge 20% of their monthly soybean purchases. I will go straight, skip all these and just go straight to what was achieved. Just a minute. Yes. So this is the slide that I wanted to share. So like I said, this is a plant that came to us in November 2020. They had done most of their research in-house, like Rajiv ji was saying, like Sumit was saying in terms of the supply demand analysis, and they were fairly confident that this is going to be an extremely high price year because the supply is tied vis-a-vis the demand for India. So that's why they were like, maybe we should at least reduce our purchasing requirements uncertainty to at least 20% of the soybeans that we buy. So this was more or less crystallized in November. So in November, when they came to us, this is a simple strategy that we told them, because a couple of things that we always find from participants is that they always want to time the market. When should we buy futures? When should we exit futures? This actually in a hedging process should not be the criteria. The hedging process, you are here because you want to eliminate or reduce the price risk that arises in your spot purchase process. So therefore, the when to buy, when to sell, more important than that is how much to buy on the futures exchange and when to exit from the futures exchange. I think that is something that is lost to most participants and results into a lot of heartache for hedgers because this is not understood. So coming back to this chart that I want to show, the futures month, that means as the other panelists also said, there are monthly futures contracts that you get to see on the exchange. So there is a January soybean futures, which was trading even in November. On the futures exchange, 6 to 8 months ahead futures are available to trade. So in November, the Jan soybean futures was available to trade. What we told the plant is that you should lock in the price for 20% of your raw material in the month of November itself. So in November 2020, when they bought January futures, their average purchase price was 4395. Now these are, like I say, actual NCDEX traded futures price. This is not an example that, okay, if in November, what was January futures? In November, if the plant bought soybean futures at a price of 4395, and this price they locked in the month of November itself. Now, what happens in the month of February? In the month for what happens for the February futures? So this in November, they locked in price for January at 4395. In December, they locked the price for February at 4399. And this they continued and they continue to do till date. Again, these are all actual traded prices. So in November, when they bought soybean for January, they were able to lock the price at 4395 in November. In December, when they bought February futures, they were able to lock it at 4399 and so on and so forth. Now, when it comes to when to sell, we advise them that you sell on the first 5 days of the expiry month. So in January, first 5 trading days, you please exit. So they got an exit. What is exit? That means they sold the future. So this is an actual exit price that they got, selling price they got, which is 4654. In February, again, we told them February first 5 trading days, you just sell your futures. This is the price that they got. And they continue to do that. The next column, of course, is your profit and loss from your futures. So that is the selling price minus the buying price, which is what you get to see for all the months. Now, most important is you have got your futures gain. Now, what do you do with that? That is the crux of price risk management. When they bought soybean futures in January, in the first 5 trading days, they covered 20% of their requirement. That average purchase price in the spot market that they were buying for was 4,700. So had they not hedged for 20% of the raw material, had they not hedged, their purchase price would have been 4,705. But because they had hedged, they got a discount of the profit on the futures, making their purchase price 4,446. That means what did they achieve? By hedging 2 months ago, they were able to restrict the price of their raw material to only a 1% increase from the price that they had blocked or locked in November 2020. So in a 2-month period, had they not hedged, the price movement would have been, the purchase price for that unhedged quantity would have been 7%. I just want to repeat this again for a critical month such as, say, May. In May, 2 months ago, that was in February, they had locked their soybean price at 5,370. When they sold it in May, the first 5 days, the futures, it was sold at 7,400. So they made a gain of 2,030 per quintal. Now, when they actually purchased in May soybeans in the spot market of Indore, it was 7,600. But the actual price that they ended up paying for their hedged quantity was 55,571. They were able to procure their soybeans by just paying 4% more than the price that they had locked in 2 months ago. Had they, for the quantity that was not locked, or had they not locked this with futures, their purchase price went up from 2 months ago to May by 42%. So what essentially over the months by hedging they were able to establish is a very small price increase from the hedged price that they had been able to do by participating on the exchange. And this was done in a very simple, no stress kind of a exercise. Like I said, you buy every day, take the average, which becomes your purchase price. You exit at a particular fixed day during the expiry month, adjust it to your purchase price, and see how the variance reduces. And for the 6 months period, like Rajiv ji is saying, who's from ITC, the highest volatile months that we have perhaps seen in our professional careers, by hedging, a strategy that they decided in November, by strategically buying every month, the plant was able to reduce the price that they paid for their soybean purchases to just 1% to 4% more than what the price was fixed 2 months ago. Had they not hedged, the price that they would have to pay, the increase in prices could be as high as 7% to as high as 42% also in a month. The next slide, which more or less is the last of my slides, is that what we want to show is that this kind of price protection or reducing the volatility of the purchase price could have happened even last year. It is not that this year prices were just rising one way, so your hedge succeeded. If you follow a strategic purchase and an exit mechanism in your futures exchange, and we ran this test again with actual spot prices of Indore, with actual traded price, we have seen that even in the year 2020, the price variance from the hedge prices in certain months was absolutely no change. So 2 months ago, the price that you fixed, that is more or less what you were able to get when you actually bought your spot soybeans, to the variance being you paid 2% more in the month of March, and you paid somewhere like 4% difference between your hedge price in the month of Jan 2020. But the most important thing is, without the hedge, your purchase price was all over the place. Sometimes it was minus 10%, as you can see in March, sometimes as much as plus 12%, as you can see in November 2020. This once again emphasizes that even during years, which was not as volatile as this season of 2021, even for the 2019-20 soybean year, had we done a strategic purchase of futures and an exit of futures, it would reduce the price variability of your spot purchase vis-a-vis an unhedged purchase procurement mechanism, which leads to huge volatility. That's all I had to share, Sujit. I hope I'm in time, and I hope my voice was audible.
Yeah, very clear, Rajni, and thank you very much. It is really very nice study. I think very take-home message for study is very good that even in the regular pattern also, last 3 months, I can say it was like a tsunami hike or tsunami spike we seen in the soybean. But despite of that, even on the regular also, you seen the protection of the prices, which is really not more than 7 to 8%, or just to protect 2% or 1%, you're protecting minimum 7 to 8%. And this ingredient market, I think 6 to 7% protection of the these prices. That's also huge money for our industry people. Yeah. I request all panelists, including is already on the video call. So please start your video camera. I request Honorary Secretary of CLAPMA, Mr. Suresh Devaraji, please start your video. Rajib, Sumit, Kapil, and Rajni also. We have a few interesting questions. So we'll take before the vote up thanks from our Honorary Secretary of CLAPMA, Mr. Devaraji. So before that, I will take a few questions. It is a general, it's not in the specific name, but you decide who can answer better. So one first question is that please share the price trend of substitute of rice, bajra, and wheat, because maybe because you all are expert in commodities, so it's all commodities you know very well. So it's expecting questions that please share the price trend of substitute of rice, bajra, and wheat. Maybe our industry, livestock industry, shift for substitute for time being. This is the first question. So I think anyone, whether you feel Rajiv or Sumit, you can take, please.
Sure, sir. If you look at, I will concentrate the discussion on bajra and other commodities, because if you look at the end, what is grains? It is nothing else but energy. So technically, we are converting grains into sunlight into carbohydrates, which gets converted into feed and goes as energy in the livestock. And the MSP of bajra has been much higher than corn of late. So most of the bajra goes to government warehouses. So this year has been a secular rally for all the commodities, and price is not at all disconnected from each other. So prices followed a pattern in which they were connected, and there was a high degree of correlation. Maybe after this presentation, we can share the price trends that we have collected over the last 6 months to the person who has asked this question, and potentially that will be a better description, a better answer to the question. But as a correlation, all commodities followed the price trend, which was reflected in soya and corn.
Okay, you mean these two commodity are the leaders and all our raw material follow the leaders like in industry. Yes. Yeah. One more question, that upcoming monsoon is make difficult to make corn export due to infrastructure and rack availability and labor availability. So is it going to make restrict the volume and the corn export?
Rajiv sir, you want to take the question or?
Yeah, Mr. Rajiv, please. Mr. Rajiv, you have to unmute.
Yeah,
I think.
yeah.
Now it's clear.
Yeah, definitely. The infrastructure bottleneck currently, what we are seeing in various ports of East Coast in India, that is as the unlocking goes on, and there will be certain ease for the movement, the port. Currently, we are seeing a lot of port congestion and non-availability of containers, shortage of labor, shortage of space, and shortage of warehouse space at the port itself. So therefore, it's a huge challenge currently, but going forward, as the unlocking takes place, I see a ease of doing the business, but definitely monsoon is going to put again a break in terms of movement of cargoes. I mean, there will be chances of high AFLA and all that, but price-wise, India is, as Sumit has explained, we are very competitive, and that's why and the takers of maize like Vietnam and others, they're a huge market. And India, whatever surplus is there, India is trying to feed it. But going forward, I mean, for them, it's a big requirement. For India, there is less surplus. And on top of that, this current bottleneck at the port and logistics and labor and warehouse issues, these are hampering the flow. But going forward, it is going to ease.
Okay. Yeah, Sumit. Yeah, please. Thank you,
Maybe I'd
Rajat.
like to add one small point, which
Yes.
as explained on the constraints on the export side. Two things have happened in last 5 years. East India has developed very good infrastructure, especially Bihar. Today, corn warehousing upward of 1 million ton in Bihar. Number two, the excess of export will move from vessels to truck and rail to Bangladesh as we get into monsoon, because which is a more easier logistics to handle. So Indian export, as Rajiv mentioned, will continue to happen as we will get into monsoon or get into the other side, but the excess will be more towards Bangladesh.
Okay, yeah. Thank you. And just connecting, Sumit, to your last comment, there's one question came. Apart from feed industry, what kind of demand for corn is likely this year for ethanol, as Bihar government and some private sector are planning ethanol push?
Sir, I will put this way: what corn is in US, because in US we produce ethanol from corn, is sugar in India. So the right equivalent for ethanol in India will be more sugar-based industry. Yes, we might see ethanol industries coming up for IMFL or bioethanol and potable alcohol, which are grain-based. Okay. But I don't think we will ever get into big time into fuel-based ethanol out of grains, because we have a population of 1.35 billion people, if you see, and for us the first priority is to meet the food and feed requirement, then the fuel requirement, which takes the last precedence in the priority list. So I don't see it's going to be a big competition for the industry, especially the maize segment.
Okay, thank you. Then there is one question that at soya seed price, especially good quality, is around 9,000 to 10,000. So also the average has reduced as of now, or may increase or may match last year level. In such case, would you think that farmer will sell at less price looking at this year's price, or farmer will help produce and sell when the price is similar or more to this year's price? So I think it is more related to farmers selling price on the seed. So there's a question.
So the question of selling price is the last thing. We have to see the reasons, as Rajiv sir has also mentioned. It's a policy or it's the reason. Okay. If we see that, for example, globally or in US, there is good rains and good crop, okay, then potentially soya prices will ease off. Okay. And then whether farmer sells it in September, October, or Jan, then the demand becomes a factor. The international demand will go away and prices will settle. What's more important to say, I will say price is a result of various eventualities that will build around that time. So it is very difficult to take a call on a price today, but you can take a call for sure that price will be very volatile in the coming season. It will not be a straight nose down or up. It will stay very volatile because we are at an elevated level of risk. We are at, if you look at risk adjusted returns, it's going to be tough. So we are going to stay in a very, very volatile year.
Yeah. Thank you.
Sujit, may I just add to that?
Yeah, please. Yeah, please.
So I guess it gives a good opportunity here to share that on the NCDEX platform, soybean October futures, which is a new crop, is trading at 5,200 currently. Yes, there is not much volume. Open interest is slowly building. But I think the takeaway from this session is that we really don't know where prices will go. So if we have a platform that is giving you a price discovery for the new crop, which is at 5,200. Maybe when in October prices come in, we have best of the world weather, the best of the world in terms of weather was good, and the production is so high that it can take care of all the incremental demand post-COVID, and there is not much price pressure that is going to come. Because of the huge crop, the prices have also come down, farmers have also benefited. But then these are all ifs, we don't know. So at 5,200, given that prices are at 9,000 and 10,000, you can lock in a certain amount of your requirement with this futures platform that you have. at least for that percentage that you lock in, which could be 10%, 5%, or just to even understand how this entire thing operates, even 1%, it will teach you how price risk management works and how it helps to reduce the volatility of your spot purchases. Because as has been the takeaway from this session, prices, where it goes is very difficult to predict. But the fact that there is a price discovery platform, one should definitely use that for price risk management, because it's an insurance which is so required, not just at such volatile times, but when it comes to commodities at all points in time. So you can begin somewhere by locking in the price that is currently you're getting to see for the new crop, which is 52.
Thank you, Rajni, for nice comments. Yeah, we have several questions, but because of time constraint, we can take one last interesting question. But we assure to all participants who has given the questions in question box as well as chat box. So we will reply you back soon. We'll take the expert comment from these panelists and we will send you the details of your questions. Just last question, that very interesting, which I also personally feel. Are feed manufacturing companies hedging? If not, what are the constraints with them? So please highlight. I think this is really very important question that from your side, what you see overall. So I think Rajiv, can you talk?
I think Kapil, you can throw some light whether feed manufacturers are actively participating currently, because I am not privy to that data or that kind of analysis. Like the participants that exchange can give the perspective, but the way the contract volume, open interest, and also the newly launched soya meal contract, which is struggling to get volume and open interest, doesn't look like that big feed manufacturers are active in this.
Kapil,
yeah, Kapil.
quick comment. Yeah.
Yes, Mr. Sujit. So I would not say they are not hedging. Yes, I think many of the companies from the each segments are coming and using the derivatives market. May not be what we expect from them, but yes, on and off, whenever they are finding markets are volatile, few of them are coming forward and they are hedging their price management. But I think it's not widely accepted in most of the market participants, most of the feed industry. But yeah, there are certainly few people who are coming forward and they're hedging, maybe against the raw material or maybe against the inventory. But we do see on and off participation from various feed industry.
And maybe Kapil, we can plan some series of some small workshop with the regional workshop, maybe once offline activities start. So thank you very much. Quick comment from Chairman, Mr. Also before vote of thanks, please.
No, Sujit, I think this was really a very interactive session, and this is just a beginning. So I think the members would definitely like to know that how they are going to get benefited. So I think Rajni is there, who can always guide them to get in, and we can always reach out to Gopalini and Kapil to take forward. I really appreciate and thank each one of you, okay, for making it very interactive session, and I'm sure that team is going to get benefited out of that.
Thank you, Neeraj. So I would like to invite our honorary secretary, Mr. Suresh Devraji, to have a vote of thanks, please.
Thank you, Sujit. On behalf of myself and on behalf of CLAPMA, I would like to extend a warm, very great thanks to all the participants, all the panel. My chairman gave me this opportunity to be here. Especially the speakers like Mr. Sujit Gupta, Mr. Rajiv Shah, Kapil, Rajni, they spoke about, and what they tried to explain and what I could gather from it is hedging. People perceive it as a gambling, but it is not gambling. It is a risk mitigating, how you can cover your risk. But doing that, it is not 100% risk also. You have to basics, you have to learn how to hedge, And for that, like I said, that you have to have in an organization, you have to build up the system that people are going to do this, and what are the plans for them. Because hedging starts, why? Because the market is volatile. And when the market is volatile, it has many reasons. It has reasons of weather, the crop, other aspects of it. All compiled together gives you a very big risk. And when to wade off this, you require to hedge your thing. Like what the last point was, how many people from feed industry this hedging thing, and Kapil said no, there are few, because for the feed industry, I understand hedging has been a new concept, though NCDEX is there for last 18 years, and we would like many members of our participating today webinar to understand what hedging is, and also not to play on it without having a proper knowledge of it. That is what I take away from this webinar. And I would like to again thank you, all participants and all the speakers, and especially Sujit and Ms. Buplani, who had taken all the efforts to organize this webinar for our knowledge. Thank you once again.
Thank you very much. And definitely, as Sureshji said, we'll look forward with the in future also workshop, and with the behalf of CLAPMA, we'll see that what more activity workshop we can do for the industry. Thanks to all, and this evening. Have a nice evening. Bye.
Thank you.
Thank you, everyone.
Thank you.